Thanks everyone for joining us. We have a really interesting panel here. We have a diverse group of perspectives that I think you'll find really informative and a broad set of topics to discuss. I thought to lay some groundwork, we could ask each panelist to answer an initial question and provide some context on their organization and their role within that organization. So maybe Nick, if you could kick us off with just characterizing the market environment as you see it and sort of what challenges does that pose to the goals of your organization?
Sure. I guess Taleb was the big draw, right? Because we kind of emptied out a little bit here, but it's okay. I understand. So I guess I would define the environment as being uniquely challenging. We've got low economic growth, low rates of unemployment, low inflation, unprecedented central bank intervention, low rates, but at the same time, really high asset prices, which would make a challenging environment for pretty much anybody, let alone insurance companies, and that's where where I come in. I'm the CIO of TIAA, which is known to be a pension plan for teachers, but does that through an insurance product, which makes us an insurance company, which means that we have insurance regulations, which forces us to invest mostly in fixed income. So low rates is a pretty big issue for us and pretty much any insurance company. The reinvestment turnover that we have, to put to work every year at lower rates is, the biggest challenge that we face.
Great, thank you.
Oh yeah, I think currently the market is where every investor has a higher level of uncertainty. They have to deal with a higher level of uncertainty. With concerns over recessionary conditions or risks or excessive liquidity in their portfolio, or people worry about whether the trade war would flare up again and its implications, or what would trigger the next recession or the next market downturn, be it excessive corporate debt or some mistakes in the policies of some government administration. So it's a lot of uncertainties there. So CIC is China Investment Corporation, is the financial investor that focuses on commercial investment returns. And we set up the New York rep office in 2017, just right before the US-China trade war started to build momentum. So good timing. So in the past 2 years, we have seen more stringent CFIUS reviews by foreign investments. And CIC, because its status as a sovereign wealth fund of China, it makes it inevitable for CIC to be involved in some sorts of geopolitical risks. So it makes it more difficult for CIC to do some direct investment here in the US. And we do hope that things could improve later on.
Great.
I work for a Bermuda-based reinsurance company called AXIS Capital. We're global. We have about 15 billion in AUM. Our CIO and I, we've been in direct investing backgrounds our entire careers, but here at AXIS Capital, we're actually investing with outside managers as well. And I personally manage our credit, private equity, and real estate portfolios. I think the current environment, if I were sitting here last year, would have talked about inflation and interest rates and what the Fed's trying to do to get inflation where they need it to be. But I think it's more appropriate to borrow from what Ray Dalio said and then what Mohammed said this morning, that we are really in monetary policy part 3. So part 2 is sort of coming to an end, and we're in part 3, which I think is targeted to, our 50+ trillion in unfunded liabilities that somebody might have to monetize going forward, as well as the trade war, which is going on as well.
Good afternoon. I'm the head of private debt for the US for CDPQ. CDPQ, for those of you who don't know, is the manager for the pension assets for the province of Quebec. We're about 225 billion in assets in 5 different asset classes: public equities, fixed income, where I sit, real estate, private equity, and infrastructure. So the challenges for us obviously vary by asset class, but overall the theme of the institution and what we're looking to do is invest more in illiquid assets, take obviously a very long-term view. We've been doing that for a long time, both in private equity and infrastructure, obviously in real estate as well, where we own buildings around the world. In fixed income, and I've joined a couple of years ago to really develop a private debt strategy where our focus is to really, again, increase the non-investment grade private debt piece of our portfolio to, we don't need liquidity, so we want to generate obviously a higher return with better structures and, again, tighter protections for us than the broadly syndicated market. So the challenge for us in both organizationally and for us in our strategy in private debt is really the confluence of continued low interest rate, but obviously being very late in the credit cycle. So how do we adjust that in terms of deploying more capital in illiquid private credit? So we have a team that's been formed of 15 people just focused on private debt, where we can originate and do our own diligence, as well as work with outside managers. And we feel that over time, there is still a lot of opportunity to invest in private credit, despite where we are in the cycle. We think that we don't see a 2008 and 9 recession the same, coming the same fashion. So we think that it'll be less severe, but still, we want to focus on quality structures and quality assets. But the fact also that we institutionally are thinking more about a low growth scenario and what are the implications for the various portfolios within CDPQ in terms of how we construct them, that is, a clear part of our strategy in terms of how do we adjust our investments and our philosophy to reflect the fact that we could potentially be in a very low growth and low interest rate environment for a long time, and still our goal is obviously to achieve good returns for the employees of the province of Quebec to generate a good return above the benchmark that we're trying to beat. So that's been our challenges.
I'm Mark Burgess. I'm from Australia. I spent most of my career overseas, but I currently sit on I chair a board for a large pension plan. But I previously ran the sovereign fund in Australia. I was the president and CEO. What are we dealing with today? I'm reminded of my students. I lecture students, as you do at my age, I suppose, and also give them some career advice. And they always say to me, why was your career so good? And it's just very simple, which is that I joined the markets about 35 years ago when interest rates were very high, and I've been sailing the rate of change ever since. And in fact, I think there are about 12 or 13 different indicators that have been very, very favourable over that period. The one that the students really struggle to believe is that I say to them, is the world violent today? And they go, yes, of course it is. And of course, today is the least violent in human history. And we know that. But there are many others, and the demographics were favourable. But one of the ones that are really critical is that interest rates just continued to fall during the period. So it's not just the absolute level of rates we're at now, it's the fact that they were falling. And that's had a compounding effect for anyone who's been long duration. And that's the challenge today. It isn't just that rates of return are low, but in the next cycle, PE, long duration assets, will get found out because there is no more rate cutting on which to revalue to bail you out. And so this is why we're at such a critical point. And it's partially why I think people are kind of cautious about what's going on, is because they can sense that the tailwinds have been phenomenal for a very long period of time, and now we have to figure out what to do next.
Mark, maybe just building on that, the trajectory of rates, is it a race to the bottom? Is there hope will change trajectory? Do you have a view?
Look, how much bottoming can you get when you've already got negative rates? But what's going on behind all of that, of course, is that we have a major demographic change. Everyone knows about demographics. But what we're about to do is we're putting economies through absolute declines in population. And the difference between a growth rate and an absolute fall in population is very significant for asset prices. The example I give people, 10 houses in the street, population growing, all houses get bid up. 10 houses in the street, population absolutely declining, and the 10th person dies. All the other houses are worth scrap because the 10th one's vacant. Now, it's not going to work like that. But what actually happens is the dynamics of the system doesn't work well. And this is what we're beginning to see transferred from places like Japan, which we know has already been going through the cycle, to Europe, to Germany, etc. And so we have a sort of major demographic change that will not only change the growth rate, but will change the way financial assets behave and credit behaves behind that. And so our hope is the 4 or 5 countries with great demographics, India, Indonesia, Philippines, places like that. And we're just not sure that it's going to all connect together to give us the growth rate that we require. Just to answer your question directly, though, I think the one positive thing that's come out since Jackson Hole is I do believe I'm on a think tank for central banks and sovereign wealth funds, and we do about 150 meetings a year with central bankers. Even they've realised that negative rates wasn't such a good idea because of the signalling effect. And I think there's a recognition that go there carefully. And so maybe rates are just going to stabilise at very low levels, but I think we've reached the bottom, basically.
Sure. Jay, thinking of rates at low levels and sort of meeting return targets, you have a number of levers to pull within your remit. Just curious sort of how you're managing that and what steps you're taking to meet return targets.
Yeah, sure. And just a point on the rates is, I appreciate that, Mark. And you know, if you think about negative interest rates, is it really a monetary policy, or is it really part of the trade war? I mean, it was started in Switzerland as an attempt to keep their currency from tripling and crushing their current account. So that the negative interest rate is also sort of a tax on capital. It's a tax on the capital account, which is analogous to a tariff. And we think that if Europe's political environment is such that they don't want to continue this policy or make it any worse, then that means that the U.S. is unlikely to have to go to negative interest rates. So that's one. And then the second point I'd make there is that inflation has been kept low by technology. That's something the Fed has now said a number of times. And if you think about e-commerce penetration in the United States, and when it sort of took off in the mid-2000s and what that did to our inflation rate, that's just now happening in the emerging markets. So we could actually see 10 years of lower than normal inflation rates in the emerging markets because they are 10 years behind in terms of e-commerce penetration in everything they do. In terms of meeting our targets, it puts everybody on this panel, and it puts everybody in a higher risk position. So yes, we're going to invest in private credit just like everybody else does, but we're going to have to be careful. We're going for the best collateral we can find. We're going for the best structures we can get our hands on, so that when the downturn comes, we're going to be able to go to our board and say, we really like what we own, and even though it's marked down, we know that it's not going to have a permanent loss.
That's great. Nick, you face a number of unique constraints with your framework. What changes? What sort of adjustments are you making?
To combat low rates.
Yeah.
It's the same that you just heard. I mean, there's no magic bullet out there, obviously. We don't have the magic sauce that no one else has. What we do have is an illiquid liability, which allows us to do as much of what Jay just described as we possibly can. Having an illiquid liability that's backing a pension, so it's perfectly fine. That's basically what you want to have backing a pension. Allows us to go out and pick up liquidity premiums, across various asset classes. So that's basically what we're doing to try and combat low rates at this point. And what we like about it is similar to what Jay was saying, is that it's also a defensive positioning at this point in the cycle as well, because we prefer privates over publics. The covenants, the ability to get closer to the borrower, work with the borrower in a bad situation, it works out to a better recovery in the end.
Sure. And Hong, maybe from your perspective, you have some unique constraints as well.
Sure. Yeah, I think colleagues here already offered a very valuable insights. For CIC, what we can do is just continue to diversify and continue to identify companies that with a sustainable business model, and we hope to build a defensive portfolio. And also for the illiquid premium, I think we would seek such premium more tied to operational improvement rather than financial engineering.
Sure. Robert, you had mentioned focusing on structuring and building a resilient portfolio within private debt and whatnot. Maybe just some more on that, just as it seems from the panel and more broadly, just a very popular area for cash flows now.
Absolutely. Well, I mean, it's a theme for the whole organization. When we talk about resiliency and building a portfolio that will sustain market volatility. And the best example of that was last year when CDPQ returned, I think, was 4.2%, which was materially higher than the index by probably 2%, because of the fact that our portfolio was very resilient and focused on quality. So despite the volatility at the end of 2018, we were able to generate a return that was nominally materially lower than 2017, but materially better than the benchmark. So that's the theme for the organization. So translating that into what we're trying to do in fixed income and private debt is, again, getting the right resources and the right team to be able to do our own diligence, develop our own view on credits, whether it's, and we do have private debt in corporate credit, but we also have other teams that focus on specialty lending as well as real estate. And we, again, focus on making sure that we understand as best as we can the risk, do a real deep dive in diligence, and be able to live with that credit if it goes through a cycle. So we specifically focus away from cyclical companies, or if we do look at cyclical companies, they will have to be levered in the right fashion so that they can go through a cycle. But otherwise, it's picking the sectors that we feel will be resilient through a cycle, whether it's business services, technology, healthcare, that we feel have long-term growth potential, even if you go through a cycle and have to deal with potential problems that we will have in our portfolio. So the good news is we're at the beginning of that effort in terms of building that portfolio. So we're transitioning from a much more liquid portfolio to more private. So we both have the resources in place in terms of people, but also the benefit of being fully invested, and don't really have the pressure to deploy capital if we feel that the opportunities are not appropriate for us. So it's, at least for now, because we're at the beginning, we do have the benefit of really choosing the right investments to be able to deploy capital in a thoughtful way.
Great. Mark, you talked a bit about demographics, but outside of that, perhaps, is there an economic factor or trend that you're seeing that is of note or concern?
Yeah, look, there's plenty, always concerns. I thought the comments previously, there's always uncertainty in the world, and so you can always find concerns. But we're clearly in transition, and take the Chinese economy, it knows it's in transition, and I did quite a lot of work up there. It's in our region. They've been looking to internalize their growth rate. They've known that growth, the export model of Japan and South Korea would eventually reach limits. But the concern for them is that this has happened a bit sooner than expected. And my sense, when I've been up there a few times this year, is that they've been worried about that. On the other hand, they're doing strategic things. They're opening up the markets. I had to speak at something 2 weeks ago on this. They're being very clear about their allowance of foreign investors. They're being very clear about paying down debt. But that's a big transitional change. They're an important grower. They've been very important to the overall growth dynamics. The question for us now, though, is, if I'm concerned, is, as I said before, the growth now has to be found in other places. And if I was running the IMF, I'd be concentrated on them and helping them do it well. So, for example, the banking problems in India today actually matter because it's one of the growth drivers for the next decade. And so they're some of the dynamics as that change. On the very positive side, demographics here in the US are good. The country is actually well run. I mean that in a broad sense. Commercialism is very good here, and this is good, but it's now patchy. And it gets to an overall theme, which is because the trends have been so great for 35 years, and this is sort of obvious to state, it'll now be the art of investing that'll really matter. In other words, if you're a private equity investor today, you won't be able to rely on falling rates to get revaluation in the entire portfolio. About 75 to 80% of your return will be how good you are at actually running the company. The rest of it, or take infrastructure. There isn't an infrastructure manager today who isn't good, right? But some of them are buying stuff that's now getting fringy, that is not very good. So it's the art of being the bottoms up as well as the top down investor that will be the trick in the next 5 years. That's perhaps obvious to state, but finding really great managers is going to matter so much more.
So speaking of really great managers and sort of finding the best, there's been a lot of fee consolidation across the industry and a bit of a jump ball, but has that opened new doors for any of you? Has that made anything that was previously too expensive now viable, or improved the utility of a financial product to anyone on the panel? Not yet.
I mean, for us, we have a team that's dedicated to do our own direct investing, but because of our deployment targets, we have also the need for third-party managers, and historically, we've looked at it as somebody that would deploy capital in a segment that we can't really do ourselves, and we still think about it that way. But now we're thinking more of managers as partners that can help us achieve our strategy of direct investing. So co-investments, which, if some of you are managers, I've heard from a lot of LPs as well that this is critical. It is very important to us to be deploying capital in a very cost-efficient way. So yes, thankfully, and we love to have fee pressure on the part of external managers because it's better for our depositors. We get to be a lot more efficient in deploying capital. But it's not, fee for us is really it's important, but it's more how does that manager fit in terms of what we're trying to do strategically? How can they help us achieve what we're trying to do in a cost-efficient fashion? And we used to think about managers as looking at folks that have a very big platform that can deploy a lot of capital. Now we're thinking, well, we have our own team. We want to be important to that manager. For us to deploy or to give a mandate of $500 million to somebody who has 100 under management, it's great. They're a great platform, but we won't really see as much benefit in what we're trying to do than deploying 500 to somebody who has 4 billion under management, where we become very important to them and help them a lot in their growth. So we're really thinking about it as a way for us to, again, achieve what we're trying to do strategically and analyze whoever comes to us for a proposal, which, there's a lot of activity on that front. People know where to find us. And we've met a lot of managers, but that's kind of how we're thinking about it going forward.
Sure.
And
Nick,
just to add to
Yeah,
that,
please.
I mean, when we invest in a private equity fund, we're going to ask them, how much are you really going to deploy? Are you going to get to 100% or not? Because if they're only going to get to 70%, that's going to waste a lot of our capital, and we're going to pay a higher fee structure. People also talk about J-curve, and a lot of people talk about it in the context of the optics of, are you losing money for the first year or second year? We think about it in the economic context of what's the total amount of fees that we're paying. It doesn't matter when we're paying them for the amount of capital that we're going to deploy. It also helps us if the manager has an existing seed portfolio that's already on the board. That gives us visibility. We know that they're going to be able to get their job done in the next 2, 3, whatever years. And it also reduces that kind of quote unquote J-curve. And then finally, with a lot of investments that are illiquid, if we can get that in a semi-open-ended or a somewhat liquid structure where we have some power to, push the stop button and just let our portfolio run off, that helps us out a lot in terms of our own internal capital management liquidity metrics as well.
That's great. Nick, as you look across a broad range of investments, is there anything that you're not doing that's off the table? It's just we're too late in the economic cycle, or is too risky a region? Is there anything that just is a flat out no?
Outside of OFAC countries,
Yeah.
Which is obvious. Probably, I would say currency. Currency as an asset class, whether it's traditional currency or crypto. It just feels a bit to me like it's, there's not a lot of expected return, but there's quite a bit of vol, and that's not something that an investor like us that has to worry about capital charges, put up against their assets, so, would be concerned about. So that's everywhere else we probably are comfortable going, but I would say currency as an asset class is a place we'd avoid.
Sure. Hong, same question to you.
Yes.
Anything off the table?
CIC is a sovereign wealth fund, so we have to play it safe. So we won't enter into too risky areas, especially countries with great geopolitical risks.
Sure. Mark, as outside of markets and with your teaching and whatnot, is there an area that you find challenging? Is it talent retention? Is it what sort of things outside of markets are a challenge for your organization?
The organisation generally, institutions. I love the last presentation about skin in the game. We have a problem there essentially because people don't own the institution. In our case, we're owned by the members, for example, or most are. And so finding people who are really, really great investors, paying them well, but also creating the culture that keeps them hopping is very important. And there is a problem for asset owners, which I found when I was at the Future Funds, first time I've been on the asset owner side, is that when you're an asset owner, you've only got one client usually, and it's the investment committee. And you don't have a lot of clients out there asking you questions, keeping you sharp, right? And in fact, the people that our staff do meet are usually fund managers who tell them how great they are, right? And so over time, the culture of the asset owner is not as sharp as the culture that you get on the buy side. And so for us, it's about attracting people, but it's about creating the culture.
Sure.
The one thing I'll say is that Bridgewater do take people, and when you send people to Bridgewater, they come back different. I mean that genuinely. I had a guy once who was always bearish, and for his career development, that is a very limited field of always being bearish. And this is a true story. We sent him up there, and he spent 3 weeks, and he came back a different man. And that's because, frankly, in their case, they do not care. They so strongly believe in their culture that they were going to ask him as many tough questions as they asked themselves. and that made him a better person. But inside asset owners, it's hard to create that hopping culture. But whereas you're an asset manager, you're seeing so many clients that you better be sharp, you're going to lose the race. And so there's some of the challenges that we have, is not just attracting, but creating the right culture so that you're absolutely at the cutting edge at all times. Yeah.
Which is one of the benefits, by the way, that I think TIAA has, because we're both an asset owner and an asset manager.
Right.
So wholly own a very large asset manager under the brand of Nuveen, and that creates, I think, that the appropriate mix inside of the culture that we're looking for.
Jay, this is the time of year when a lot of folks make goals for the next year and whatnot, both on the business side, but on the market side as well. Anything on the agenda for you guys as you look forward?
Yeah, sure. I mean, so from the investment perspective, I think this is probably front and center on a lot of people's minds, is preparing for a possibility of a recession. You know, how is your portfolio going to look in that scenario? And you know, are you investing in the right things, and what actions may you not take if that happens? On the business side, you know, the insurance and reinsurance business is also it's a challenging, and there are many who know a lot more about this topic than I do, but it's a challenging business. You know, there's a lot of technological disruption. There's a lot of competition. Recently, there was an M&A spree in the reinsurance industry. You had larger firms from Asia paying even 2 times book to buy reinsurance companies because they looked at them as just kind of a bond portfolio. One of the things that we do at atAxis is we have a team, not my team, but we have a team dedicated to strategic investments in fintech and insurtech, and they engage with outside partnerships to sort of get ahead of that and play offense instead of defense.
Great. Anyone else? Any initiatives?
I was going to add one thing. For us, it's really it's a couple of things. One is because we're deploying more in private debt, we know that there's going to be more problems in the portfolio. So, which is something that's relatively new for a team that has been mostly with more conservative, safer credits. So, how do we think about and how do we set ourselves to be able to manage those problem situations? Having the right skill set, it's something that we're thinking about for 2020 and beyond. We're also looking at potentially investing outside of the North America and Europe, where we currently have our teams looking at emerging market. We're starting to think about how do we deal with Asia or potentially investing in South America. It's been challenging in terms of finding managers in South America that we feel would be a good strategic fit for us. We are putting in place something in India, where CDPQ has been very active in India over the last 5-6 years, working with local partners to invest in, particularly in infrastructure, and more recently in private equity. So we're probably going to do something in India as well in corporate credit. There's a group of very, very good managers that have established track records, and for us, it's a way to dip our toes in emerging markets in a way that will give us the ability to learn about the market and see if it does provide a better return for our capital. So not huge amounts of money, but certainly something that help us expand beyond North America and Europe.
Great. I would agree. The challenge around distressed investing is a pretty big one, because it's very difficult to maintain a team that has that skill set when there aren't a lot of distressed assets. You're not going to hire a bunch of people and have them sit there and do nothing. They're not going to want to sit there and do nothing, waiting for the wave to occur, and it's been much longer than anyone expected for that wave to come. So that's a huge challenge, I think, for pretty much every asset owner.
Sure.
The interesting part is whether you want to invest in distress. We're not doing that in fixed income within our group. Some of the pockets of CDPQ is doing that, but you're right. It's been relatively spotty in terms of return in the last 5 years, just because of the environment that we've been in. But for us, the focus is really not necessarily to look at investing in distressed assets, but just managing the problems that we're going to have, and how do we deal with that in the most cost-efficient fashion. Whether we do it all in-house or do we use outside resources, we're still trying to figure that out.
Sure, fair enough. Well, with the idea of leaving time for questions here, we're going to do a little bit of a lightning round. So these are 4 questions, and we'll let each of you answer them, and then we'll go to the next question. So will the S&P 500 be higher or lower in 12 months, just up or down?
Are we going to come back in 12 months?
Yeah, exactly.
Am I going to be held to this in any way?
It's documented somewhere.
Lower.
Okay. Huh?
Well, I really want to ask my colleague, but I think it would be higher. I hope it would be higher.
Yeah, I'm going to say lower.
I think it'd be lower. I don't see how it'd be higher, to be honest with you.
I say high.
All right.
Interesting. All right.
Did you go to Bridgewater?
Yeah.
Yeah, they'll beat me up and I'll go lower.
Yeah. Next question, 10-year yields, higher or lower in 12 months?
You know, on the hope side, higher, but I get the feeling lower.
No.
I think flat or target around 2%.
I think it might be lower, but not by much. Yeah.
Yeah, I buy the flat story.
Fair enough. Will Brexit be resolved in the next 6 months? Yes or no?
Yes.
Fingers crossed.
No.
No, I think immigration's a big issue.
I think so. Yeah. I hope so for them, but yeah.
Yeah, I think they'll resolve it. The most important thing is they do it on the right day of the year because they're the only country in the world that doesn't have a national day, right? And they desperately need a sense of identity, so they should choose the summer. I picked July, nice day to have a public holiday on which to celebrate, right?
What does resolved mean, by the way?
That's
yeah.
for you guys to decide. Yeah, that's the last one before we do questions with the audience. Will we still be talking about crypto in 3 years?
Yes.
Oh yes, definitely.
Definitely.
I think so.
Absolutely.
Great. So we'll open to questions from the audience. I don't know if we have a mic or we're just raising hands. We do have a mic. We have one in the back there.
Thanks, Travis. Rob Colleran here. On the emerging markets or sort of the international expansion, a couple of you all mentioned that, but then some difficulties. Is that related to potentially the scale of, you all are wanting to put out more capital, or is it sort of the dynamic between family-owned businesses less open to equity give up or rule of law type things? Can you expand a little bit upon that? I think this was driven a little bit from our folks from Canada and a couple of other.
Yeah, I can take that. I mean, I think it's all of what you said in the sense that when we're thinking about where it makes sense, you need to think about obviously the legal regime in that country, the history of investing in your asset class, track record, the type of teams, and is there a cultural fit in the way that people invest in your asset class versus what you're doing yourself, and then what are the returns? And in our case, being Canadian, when we make an investment in private equity, we don't really think about currency because we hedge it at a higher level, and we just, whether it's euros, whether it's Canadian dollars, US dollars, sterling, whatever currency we can hedge, we think about it, and it's not a factor in our return decision. But when you're looking at emerging market, it obviously becomes a bigger issue. And thinking about those markets does it really make sense to deploy capital if at the end of the day, with the tax implication, with the currency implication, you're going to end up with a return that's marginally better than what you can do domestically? Does it really make sense? So these are all factors that we think about as we look at deploying in emerging markets. And in fixed income, in corporate credit for us, it's something that's relatively new, but that's how we've been thinking about it. And so far, we've thought of India as the first step for us to kind of dip our toes into that market.
I think that if you look at standard markets and emerging markets, they've rallied, and there's not that much of a risk premium there versus developed markets. We are looking at specific opportunities in emerging markets as well. So, for example, India just passed the bankruptcy law that helps real estate debt, that sector, working out real estate loans. It makes it safer. Australia, as Mark knows, has a situation where you have a banking oligopoly. And so the yields that you can earn in private credit in Australia with really good collateral are actually quite high. In Brazil, we've looked at the system of federal claims there, and there are managers that try to accumulate those at a discount. In Argentina, hard to invest in, but as many in the room may know, that they have a public-private partnership opportunity there where they're building power plants, and it's all sort of US dollar denominated. So we are looking at specific situations. I think standard markets have lifted.
Yeah, I must say we're at a critical moment though, because we need to have the rules of the game still set the way we've been used to it. And I'm not suggesting it necessarily will change, but I'm very impressed by how brave the Canadians are in terms of allocating to some of these markets. But you would not want to get in there and get your capital stuck. That is distinctly possible if we get bad behaviours by everybody, where we don't believe in the system. And this then gets to infrastructure. For their sake, it'll be great if we can convince the countries to have really sound and stable regulatory environments. But with the volatility that's going on, we need US leadership, and we need leadership from everyone else who's set the system to continue to set it. If they don't, then we've got to think about exactly what sort of risk we're taking. It's an outside story, but it's the first time in the last 35 years that I'm now particularly thinking that through personally.
Yeah, that's actually a good point. The world is moving against globalization. There's no question about that. So there's a lot of potential peril. And so TIAA is huge. I mean, we have the scale. We have a very large investment organization. We're pretty much across the globe. We're investing in commercial mortgages in Australia. We're investing in real assets in emerging markets. But those are genuine concerns now, because you're right. The world has shifted, I think, into a different regime.
It's shifted. We have a slightly quirky thing. I talked about the positive demographic countries. The thing is that the ones that are the most positive also have a youth bulge currently. And youth bulges are very dangerous periods. Amazingly, in Japan in the late 50s, there were student riots because they couldn't employ them quickly enough. US late 60s. Whenever you get this youth bulge coming through on a 10, 15-year view, it's fantastic. But in a short-term view, and this is partially why we're getting riots and other things, partially. And some of these big countries have got to get through some of that stuff too. That said, if you're a long-term investor like we are, and you believe in the system and we continue to work on the system, that's where you're going to get future growth.
Yeah, combining the youth bulge with a wealth gap.
Correct.
It can be a pretty dangerous combination.
Yeah.
Yeah.
We recently had a change in the leadership of European Central Bank. And together that fact and the noise that comes out of the insurance industry as well as banking, especially in Europe, there's an obvious desire and pressure and wish, I guess, to change the regime. But what do you think in your mind is the chance for something like that happening and the knock-on effect to our markets?
Who wants to take that?
Yeah. So you're talking about the change in regime at the central bank in Europe? Yeah. So I sit on this think tank called OMFIF, and we, as I said, had 150 meetings a year with central bankers around the world. And yeah, Europe's in a critical moment. The central bankers themselves need to rethink this. I asked them recently, the thing I was added, how much work have you done on demographics? So for example, we're used to saying that Japan's not growing, but GDP per capita has been one of the best in the world, right? And so maybe they've got to rethink some of their processes and systems. But you're absolutely correct, is that Europe's got some moments of truth. A lot of pressure on Lagarde, thinking that she'll bring in fiscal. I'm not so sure she will. So yeah, it's one to watch. But I think it gets to a generalised theme, which is central banks have run out of bullets. I think Jackson Hole was very significant this year. They're essentially saying that. And we as investors just have to get used to that scenario. Yeah.
But I would argue that part of the problem has been that monetary policy and fiscal policy just haven't been aligned.
Right.
Right. So, when you had monetary policy easing in Europe, you also had fiscal austerity, right? So if you can get, actually it's true for the US as well, get your act together and find a way to actually, put those two policies together, enforce infrastructure, for example, just seems like, the right thing to do right now across the globe. That could, increase growth, increase employment even further than it is already. But it just doesn't feel like the impetus is there. A regime change or a change in leadership is the appropriate time to start thinking about these kinds of things.
I think it's a good point. Jackson Hole was particularly significant because they're prepared to talk about fiscal, central bankers are, and they know that fiscal is political. That is a big psychological change for them, because they're basically saying we've run out of ammunition. It's your very point. They do not want to look too political because they'll lose their independence. And this is the trade-off that's going on between central bankers and everybody else at the moment.
Right, because you don't want to go even lower in rates, right? We talked about that before. We want to keep rates close to zero and use something else to try and stimulate the economy.
I think it's also appropriate to think about what would European monetary policy be with Italy and potentially Greece not being part of the euro as opposed to being part of the euro. That, including them, introduces this sort of deflationary force because you're putting an artificially strong currency on countries that have lower labor productivity. So, and I personally think it's still in the next 5 years one of the risk factors that you do see a country leaving the euro.
Mark, through your think tank, what sort of reliance do central bankers place on the need for fiscal policy? Meaning, like, when we say they're out of bullets, is it onto you fiscal policy, or are they fully reliant on that for the next leg of stimulus? Or
They've started to hint at it, and remembering that they've not got involved in that for a very long period of time. And I think the other thing is to be a little critical of central banks. I'm reminded of, I lived in New York in the 87 crash, and after the 87 crash, remember the bank credit analyst, the joke was that they said have 65% cash and whatever it is, 35% canned food, right? and that was because they were thinking about the depression. They were looking at the two, and the thing that we learned from the 87 crash was that monetary policy can stick a floor under things. And that's now 30 years of doing the same thing. And even the central bankers, they don't want to stand up and say, because it's a huge blow to your ego as a central banker to say, I've run out of bullets, I've lost my power. But I think even they are starting to indicate that. But they're trying to figure out a way to do that without becoming political. MMT, let's face it, if MMT came in, they're essentially becoming a fiscal arm of government. They should probably just give up independence and see what happens. I mean, we might finally get inflation back. But they're the sort of dynamics that at the margin, central bankers, I think, are changing their thinking. Yeah.
I think we have time for one more question, or we'll close it there, perhaps.
There's a question right there.
Oh, I'm sorry.
Yeah. So basically, I guess one of the topics that came up was the demographic changes in emerging markets and the youth dividend in certain countries, make them give them certain attractive investment qualities. Do you think there's an emerging sort of, given this deglobalization, an emerging metric where sort of these countries that are benefiting from the move away from certain parts of Asia, the supply chain, to other countries, and sort of what would the metrics you would look for that change to observe any of the changes?
Anybody?
Could you repeat the question?
Yeah,
So within emerging markets, what signals would you look for the change in regime or the change in sort of comfort and stability of investing? Is that
beneficiaries of the change in supply chain?
I got you.
There's been some academic work, which I tweeted out to all of my 500 followers. So if you look me up, I'll be 501 or whatever it is. Probably most of them are robots, right? But I just can't remember the lady's name, but she's done very interesting work, and just recently, and she's put out some stuff looking at how China's behaving here. And so they're attaching their supply chain to Europe and others. There's no question. I go to a CFO event each June where we all sit around with CFOs. CFOs are great because they're informed, but they're not egotistical like CEOs. So they tend to tell you what they think and you can have a conversation. And there's no question the last two meetings, we do this in Europe, there's lots of major global CFOs. They've just stopped investing because they don't know where the supply chain is going to go. And I think they're sitting out, frankly, the Trump administration to see how this plays out in the next 12 months. But the answer to the supply chain is not that simple. It was interesting, Mohammed Al-Arian mentioning bimodal distributions. The one he didn't mention today, and this chart I use a lot, the ILO did one on the bimodal distribution of labour, right? And this has been in case, in the 1980s, we injected 1.5 billion fresh workers at cheap prices. And the two curves are trying to come together, but they're still a long distance apart. And so that's the friction of the globalisation, is that as I say to people, we all started in the 1800s, we'd have one global distribution of labour. But instead we're in disequilibrium. And so that friction is bumping. And I think what you're trying to allude to there is, do the countries on the left-hand side, those with cheap labour, trade with each other because everyone else blocks them off, or some other mechanism? And there's no doubt global firms are trying to figure this out. And so unfortunately for Britain, the easiest decision they can make is just not put anything in the UK, because they don't win, doesn't matter what happens, right? But they're trying to figure out these distribution channels, and when you talk to them informally, even, should I put in Mexico? Is that actually already set or isn't it? And so they just hesitate a bit, and so you get 10 or 15% corrections in investment. And so I think it'll get resolved. I think it will be more regionalised, but it's still working its way through the system. And she's done some very good work if you just look up my tweet.
might be a good way to get inflation up, anti-globalization, I guess. Not the best way, but that might be one way to get it.
People ask about inflation, and I'm reminded of this. 15 years ago, I interviewed a strategist, and she was very young. And I said, what do you make of inflation? She looked me in the eye and she said, a statistical anomaly, right? Because she'd never seen it, she'd only studied it. And she really helped me. She made me rethink my own thoughts because I'd only ever seen inflation. But now at the margin, if you ask anybody, everyone believes in lower for longer. That's an absolute consensus now from what I can observe. and no one really believes inflation is coming back. But if you think about what's helped inflation, free trade's helped it. Global warming won't help inflation with rising food prices. There's a bunch of these dynamics that at the margin could arguably be, on a 5 or 8 year view, the emergence of a style of inflation that perhaps we haven't seen before.
When we think supply chain, we think labor costs are higher in China, so you're going to get more manufacturing in Vietnam. On the other hand, China is benefiting from more pharmaceutical development coming into China. That was traditionally only India. But one of the trends we see is e-commerce across the world, and e-commerce increases the demand by an intensity factor of 3x, increases the demand for simple industrial warehouses. So that's something that's been in the newspapers a lot in the US. I think Blackstone's been in the news as buying billions and billions of dollars of warehouses in the US. When we look at Europe, France, Germany, continental Europe, especially Spain, their e-commerce penetration is anywhere from a few years to even 10 years behind the US. And so we like the idea of buying industrial warehouses in continental Europe. That trend is also happening in the emerging markets.
I just want to add that it won't be that easy to move supply chain out of China. One thing they have to think about is the educated labor. And just think about it. You can assign a U.S. manager to China because it has a better working environment. But if you want to assign someone to Vietnam, then probably they would think twice.
Great. Well, I think we're out of time, but thank you to each of our panelists, and thank you.